Thank you, Paula, Rachel, and the rest of the admin team for setting up one more Faculty Insight series. Today, we are going to continue on some of the themes that we've touched upon so far on how economic policy making is responding to the outbreak of the virus. We're going to shift gears a little bit and turn attention to Europe today. Even though some of the policy prescriptions are, of course, commonly applicable in many parts of the world. We have with us Professor Marti Subrahmanyam, who has been very active. Of course, Marti is active always, but he's been very active in the past month in putting out a series of innovative, timely, and I would say fairly practical proposals of how to deal with the fact that while flattening the curve of infections and fatalities, we have to incur significant economic costs as collateral damage. Marti has been working with his co-authors in Europe on some of these proposals, but he's also been active in what I might call a sort of backdoor dialogues with policymakers in other countries. So I'll hand it over to you, Marti. We'll take questions after you take us through. And just to end on a light note, one of my friends who was Marti's students in the 90s, he could never pronounce Marti's last name, so he used to call him Marti Subrahmanyam. And so, Marti the Superman is going to tell us about his plans for fixing Europe's immediate and long-run issues. Over to you, Marti. Thanks.
Thank you, Viral. Good afternoon, friends of Stern and guests. We are in very difficult times, and my thoughts are with you and your families, and I hope you're able to cope with the crisis as best you can. My talk today will be about how the crisis has affected Europe, in particular, how it has affected, how the crisis has affected Europe, in particular, its citizens, its firms, its institutions and markets. Virtually everything around the world has been affected, but I think in the case of Europe, this is really threatening the very survival of the European monetary system, which includes, of course, the ECB and other institutions, and the very existence of the European Union. So it's an existential crisis for many people in Europe. And this crisis has brought forth tensions which were beneath the surface between the stronger countries in the north and the weaker countries, fiscally weaker countries in the south. And although the leaders managed to cobble together a deal just before the Easter weekend, it's not clear whether the deal will stick and whether it will be sufficient to actually tackle even part of the problem. So I'm going to give you a brief summary of how the markets have reacted, and then I will talk about the extent of the problem that has hit Europe, the kind of interventions that have been tried so far, and also the problems with those solutions and our modest proposal. So this work has been conducted jointly with a group of my European colleagues. They're all from different countries, which has brought in a variety of perspectives that helped us to formulate our plans. So we've written also a bunch of policy papers and newspaper articles to sort of outline our proposals. Of course, these are in less technical kind of fashion. More technical details are found in the policy papers. So, as I mentioned in the very beginning, and I think it's probably well known to all of you, the financial markets have been completely devastated by this crisis. I think many of you know this from your own wealth being shrunk in the last few weeks. But I think the fact of the matter is, and this is quite surprising given what we know today about the crisis, the markets were pretty sanguine until really late February, which is kind of surprising considering what has happened since 3 weeks or just 3 weeks ago. And of course, the damage across Europe has been pretty much across the board. I think almost a third of the market cap has been wiped out. Of course, in the case of Europe, the listed firms, which has been the focus in many cases in the US, are not really the economy. There's a huge discrepancy between the listed firms and the economy. What is even more obvious in the case of Europe is the sharp impact on the finances of even the healthiest governments, such as Germany, Austria, and the Netherlands, which have all been affected. The measure of this kind of stress is really the cost of insuring the public debt, the sovereign bonds of the country, and the so-called credit default swap spreads have risen dramatically. Germany's has gone up by almost 150% to almost 23 basis points from a very low number of 8 or 9 basis points. And Italy's, of course, has gone up much more, as I show in the next slide. So although still Germany is a rock solid credit, one of the best credits in the world, Italy is under a lot of stress. And of course, Italians are justifiably worried about whether the government has the fiscal capacity to tackle the task ahead. So what has been attempted so far in Europe? Well, basically the sovereigns, that is the individual national governments, have tried to help the individuals and firms through workforce financial support of various sorts, because Europe already has a good social safety net. They've basically made it even more active. They've provided guarantees to the banks so that they continue to work to lend money to the firms and individuals in some cases. So at least the present liquidity crisis can be handled. At the same time, the ECB has unleashed a total of about 1.1 trillion euros of infusion, principally really by the so-called PEPP, the Pandemic Emergency Purchase Program, which consists of buying securities, paper of all sorts, including paper that the ECB has hitherto been unwilling to touch. For example, Greek paper and some of the other commercial paper of non-financial firms. Now, if you look at the actual response numbers, Germany has unleashed its big bazooka, as they say, of almost 750 billion euros and counting, whereas Italy has had only a modest kind of response in relation to that, only about 25 billion euro. These numbers were as of last week. They have been increased a little bit, but still the discrepancy between Germany on the one hand and Italy on the other, and the other countries in between, just they have different budgets and they have different capacity to handle the problem. So what has been happening so far? Well, primarily the intervention has been in the form of debt instruments, essentially lending, especially at concessional rates to firms and institutions and individuals. But also these are essentially uncoordinated across countries, with the exception of the ECB intervention, the European Central Bank's intervention, and to a limited extent, the European Investment Bank's intervention. But those are the EIB so far has been relatively modest. So essentially, we have the problems that debt instruments have, the problem of indebtedness and the incentives, perverse incentives that debt often creates, and also the fact that we have a really much stronger response in Germany and the Netherlands, for example, compared to Italy and Spain at that extreme. So how do we ameliorate this problem? Well, our solution is to say, let us try pan-European solutions, and let us infuse equity, because I think most commentators who are much better informed than I am say that this crisis is not going to go away in a quarter or two. The after effects will last for at least a year, perhaps two. So giving debt, providing debt, even at concessional rates to companies, is not going to solve that problem. They need equity. So, of course, if they need equity, the solution which has been well tried and tested during the global financial crisis more than 10 years ago, that works reasonably well with large companies. Implementation has been a little bit different. The US had a very successful implementation, UK less so, but it has been tried basically bailing out large listed companies. But the point is that in Europe, first of all, you need a European solution because, as I just mentioned, Italy and Spain simply do not have the wherewithal to intervene in any sizable manner. Now, what about the small and medium-sized enterprises? I think many of you probably are aware the SMEs, as we call them, are an important part of the economy everywhere in the world, but is particularly true in Europe. If you look at the numbers in Europe, the number of employees and the number of enterprises, as well as the value added in these SME firms, is by far the majority of the economies. In Italy and in Germany, it is a really substantial part of the economy, but it's actually Europe-wide this important. So any solution that is proposed has to deal with the SMEs. Now, SMEs, first of all, are hard to reach. They're not listed. Furthermore, they're typically family held, and they are unwilling to dilute their equity, take in outside shareholders. So these are the characteristics of the SMEs. So what is our solution? We design a very simple scheme where the fund, by the way, we are working out the detailed architecture of this fund as we speak. Let us call it the European Pandemic Equity Fund, will infuse cash very quickly into the SMEs. Now, what is the quid pro quo? What do they have? What do the SMEs have to give in return? Well, they have to agree to an increase in their tax rates, corporate tax rates, with an appropriate holiday for a certain period of time, let's say 5 years or so. So the tax rate will go up, and that is the return that the European Union or the European Commission will get for its investment. Now, of course, today the clouds are very dark and nobody knows how many of these SMEs will survive. But I hope many of them will survive and some of them will do well when we emerge from this crisis. So this is very much like a quasi-equity infusion. So the good firms will survive and prosper and pay back substantial amounts to the common fund. Some, unfortunately, will not survive, and the government has to write off those investments. So that is the extent of it. So we are talking about something at the pan-European level. Now, I am learning much more about all these different institutions at the European level. There are so many of them already, and my colleagues in Europe who are much better schooled in these matters than I am have been teaching me how difficult it is to actually do these, and unless you understand the precise mandates and the constitutions of these different entities. Some of them can do certain things, some of them cannot. So we have to keep in mind the institutional constraints when we propose the precise design. So our proposal really is to basically share the risks across countries and across firms. And essentially, it's very much like a gigantic mutual fund, of course, constructed during this crisis. And of course, the rewards and the risks, of course, will be shared jointly across the different sovereigns and, of course, indirectly their citizens. So that is basically my broad proposal constructed with several of my European colleagues. So I will now hand it back to Viral to take it over and maybe pose a few questions from himself and from the audience. Thank you very much.
It's great. Thank you so much, Marti. That was very crisp and precise. Let me kick off the Q&A, with a question seeking to understand a little bit better the specific design that you have. So, is it in some sense essentially what one might call as essentially a liquidity lifeline? So you essentially transfer cash to the small and medium-sized enterprises, and implicitly you will collect a return on it over time through higher taxation, let's say over the next 8 years or 10 years or something like that. Is that correct? And if it is, then the second follow-up question I have, Marti, if you could elaborate a bit on, do you see that the support to each SME would be linked to some measure about its past taxes or its scale in some manner? How would you apportion, say, the total pool of resources that are being generated for infusion across different SMEs? If you could throw, because the tax collections will of course be proportional to the profits of the firm. So what sort of scale one would put?
Yeah.
Thank you, Marti.
Yeah. Thanks, Viral. These are very good questions. Actually, obviously, we need to collect a lot of data, and some of the details we are just learning about. Let me talk about 3 countries where I'm personally involved. One is, of course, Italy, which is most stressed. I'm working with some Italian colleagues to get the information on the SME sector in Italy. That's one. And I have been working with the Ministry of Finance in India to collect similar data. Actually, luckily, we got much more detailed data, and very quickly, to my surprise, on India, where the idea is being considered as well. At the same time, in Singapore, my colleague in Singapore and I have just published a piece in yesterday's Business Times, which is the business newspaper in Singapore. And some of the policymakers in Singapore have been asking us some of the details. So let me give you the broad outline. So, for instance, the example, this is still only an example, we need to calibrate it properly. The example we propose in Singapore is the minimum criterion is you ought to have been profitable from a tax perspective. So if you're not been paying taxes because you're not profitable or you're evading taxes or whatever it may be, you simply do not qualify. That's a minimal criteria. So we have, for instance, on average in the last 3 years, you should have made profits. That's a minimum criteria. So in other words, that's a test of whether you are viable as a business in the first place. Second, we say that the repayment will be in the form of increased taxes, and we have not calibrated. Let's say it's a 3% increase in the corporate tax rate, which is what we propose in Singapore. And there'll be a holiday for 1 year. Let us say that in Singapore, the tax year is from July to June. So the present 2020-21 year will be exempted from this increase. The normal tax rate will apply. But thereafter, the higher tax rate will be applied for a certain number of years, let us say 5 to 7 years. So those are the parameters. Obviously, we are running some simulations to see whether, obviously, the government has to make a reasonable return, the taxpayer, citizens have to make a reasonable return. At the same time, it should not be too burdensome for the SMEs to repay. So that is the fine balance that we have to strike. That's where we are right now, but we need to do a lot more simulations and calibrations to come up with a reasonable solution.
A follow-up question, Marti, which is this is from one of the participants. His name is Harsha Marti. You might be familiar with this gentleman. The question is this equivalent to a non-voting preferred instrument that can be repaid by a cash flow sweep that is limited to a certain percentage of profits in your specific proposal, the tax rate? Yeah, I have a follow-up question, but maybe you can respond to this first, Marti. Thanks.
Yeah, I think it is right. The conceptually, it is very similar to that. But I think I emphasize 2 things. First of all, it's non-voting because many of the SMEs, particularly all over the world, but particularly in Europe, they're very wary of allowing outsiders to get control or even voting rights in their firm. So it has to have no voting rights. So the people who run the business are best qualified to run it. The government cannot interfere in that. That's the first thing. Secondly, the fact that it is the dividends are not paid. Dividends, I mean, in terms of higher taxes, are not paid in case the firm doesn't make money. So that relieves the firm of this huge headache that they have to make payments on the bank loan, which is the situation, for instance, with a lot of the additional injection in many parts of Europe. It has to be repaid. And that puts on a huge burden. And in some cases, they may be tipped over by this additional kind of burden. So that's what it is. Yeah.
Yeah, and if I could, I think you have partly answered implicitly the question I'm going to ask, Marty, but let's consider the sort of federal support that is being proposed in the United States, not necessarily for the smaller firms, but for some of the affected sectors such as airlines.
Yes.
And one of the recommendations has always been that the government support should come in as debtor in possession financing.
Yes.
Now that is actually almost at the other extreme, where it is a debt contract, and in fact it is supra priority. So it actually even dilutes the priority of all the existing investors. So can you elaborate on what is the specific situation we are talking about, and is it about is it the nature of the protracted recovery that's the primary concern, or is it that because we are talking about small businesses that you recommend this equity-like instrument? Put another way, Marty, suppose you were to make your recommendation for federal support of a large firm.
Yeah.
Would you also recommend an equity-style instrument, or would you in that case prefer a debtor in possession financing?
That's a good question. We don't think our solution is really a exclusive solution. I think it can be complemented with some other debt-like instruments. But frankly, we have been much more focused on SMEs. The existing facilities that have been created by banks and in some cases, national development institutions, those are really debt-oriented. So one could imagine that these are available, and the concessions available to SMEs, for instance, a holiday on various taxes, payroll taxes, and so on, which have already been put in place. Those are already in place, and those could actually be strengthened. But frankly, in the end, the whole system will collapse unless these firms have a strong equity cushion. By equity cushion, I mean an instrument that the firms managers and owners do not feel somehow burdened to repay. Because let us say that all goes well and we back in business in about a year or year and a half when a new vaccine is developed, etc. I mean, the fact of the matter is there are 101 other problems that the manager will be facing in running his or her business. And the last thing he or she wants is to have this burden of having to make the payment to the bank. So we want to actually alleviate that concern and basically have let's say, a more patient investor, that is to say, an equity shareholder. By the way, one other thing I should add is we do not envisage this fund that I talked about as to be a purely sovereign type fund. We think in the long run, it could actually take in outside investors, for instance, private equity players, who could take a stake. Of course, I don't want to get ahead of myself here. Obviously, we have to establish the profitability of this fund. And once it is established, it could take in outside shareholders in the form of investors in various types of securities. It could be some type of equity. It could be some type of securitized kind of programs where different tranches are issued, and the tranches could be taken up by different types of investors. That's our broad design.
Right. So I think just continuing a little bit further, Marty, on the specific nature of the contract.
Yes.
So our colleague Yaakov Amihud is asked a question, which is, would you consider as an alternative an instrument which is hybrid, more in the line of the contingent capital or COCO instruments that have been proposed for the stability of the banking system, and in particular adopted in many European countries? So this Yaakov Amihud's specific proposal is a loan with deferred interest payment. Those firms that can repay it will repay it, and those who cannot will later apply for conversion to equity.
Yeah, my feeling is, although the COCO concept was introduced with much fanfare during the financial crisis, especially for banks, I don't think it worked out very well. I think part of it is the fact that it is going to be converted according to some criteria which are not sort of market price-based criteria, I think is a huge deterrent. And the other part of it is, I think one thing I forgot to emphasize is the fact that our program is actually voluntary. If a firm feels it is not qualified to do this or does not want to do it, that's fine. Okay, it's only offered as another possible sort of instrument And if people are not comfortable taking it, that's just fine with us. We have to, of course, there's going to be some degree of adverse selection that takes place. Maybe only the poorer quality firms will apply. So that's why our design, which I have not spelled out here, we want to involve not just the national development banks, but the commercial banks using their own conventional credit evaluation methods, who will actually look at these firms and actually try to weed out some of the ones who are not likely to succeed. Our taxable profit-based minimal criterion is, of course, one method, a minimal method, which is applied in our conception across the Eurozone. But on top of it, the national development banks or the commercial banks may be asked to actually put in a few more checks and balances to make sure that people who are not likely to survive will not be given succor under this scheme.
Thank you, Marty. Let's switch gears a little bit towards the fund idea that you have mentioned.
Yeah.
And of course, it comes down a little bit to that, most of these national or supranational programs require some governance mechanisms in place. The value of structuring it as a special purpose vehicle or a fund that is focused exclusively on support of the SMEs could be that it's easier to maintain the right governance standards rather than it entering a general pool of allocations at the supranational level. The question from Marius Hurgilas is, how would you potentially govern this fund in terms of multiple political as well as industrial interests that are likely to arise? In effect, I think implicitly he has in mind perhaps both the national level allocations across different European countries and possibly also that there could be sectoral lobbying that might take place to favor some sectors over others. Do you have in mind some objective criteria for these sorts of allocations? And one proposal that I have made in the context of the Paycheck Protection Program in the United States, that first and foremost, it should be limited to sectors that are most affected based on some objective criteria, or those that have suffered the highest number of employment losses or have already seen failures, etc. But we would love to hear your thoughts, Marty, on the governance mechanisms for such a fund.
Exactly.
Because if it's free money with a long equity gestation period, there will be a lot of demand, including from those who don't really need it or don't need it as much.
These are very good questions. In fact, my European colleagues and I have been wrestling with these questions for the past week, where we are actually writing the 4th policy paper, which actually deals with some of these issues. One of the questions we are trying to address is the indebted countries, such as Italy and Greece and Spain, to ask them to put extra money into this fund in the same proportion as their existing allocations to, say, the ECB, the so-called capital key of the ECB, it would be asking for too much. So we are proposing a structure which is either using the European Investment Bank or the European Strategic Investment Fund, which is an arm of the same entity, where the capital key is a little bit different from the ECB's capital key. But it has been there, and it is already agreed by the member states of the European monetary system. And we feel that the equity of the fund, I'm talking about the fund itself, the equity of the fund will be in the same proportion as existing, widely understood and accepted capital allocations. But the fund will be also able to issue debt to its member state sovereign programs, as well as to other investors. For example, currently the European Investment Bank issues debt, and of course the debt is high quality paper, AAA paper. It's bought by several people. So that sort of structure will continue. Now, we do also want to make sure that this entity will be a little bit removed from the normal political arm wrestling that happens everywhere, but particularly in the European Union. So we want to keep it a little bit distant from all the sort of pushes and pulls of European politics. So, of course, I'm not a European, and I am not as probably as sophisticated in my understanding of European politics and the bureaucratic system. But my colleagues are, and we are trying to put in as much of their expertise as possible into this design to make it a little more realistic. Yes, the governance is going to be a challenge, but I would say I would use the Occam's razor for this test for whether the mechanism is good or not. It should be simple, and it should be normative, it should be objective, applicable across countries. So people do not say, oh, that country is getting more or that industry is getting more. It has to be very simple. So actually, that is a discussion we are having amongst ourselves. Many people have said, why don't you put in ESG initiatives, green initiatives into this program? And why don't you take care of some of the other problems of lesser developed regions within Europe? So my bias, some of my colleagues have a slightly different view, is to keep this simple. Because if we throw in all these other objectives into the pot, I think we'll get a mishmash and nothing will get done. I want to also emphasize this fund has to be profitable. This cannot lose money. We're talking about a lot of money, even for a pan-European fund of the order of hundreds of billions of euros. And with debt, it may be probably much larger. We don't have the exact numbers right now. So if that is so, and remember, we will have to make sure that this fund will have to maintain a very good credit rating. So anything that endangers that credit rating will not be undertaken. Yes, we are likely to lose some of the really weak SMEs in the process, but we don't want to endanger the survival of this fund and essentially its pristine credit rating. So that is very, very important. And also that is not negotiable. In Europe, EIB's AAA credit rating is not negotiable. No European leader would be willing to tolerate that. So we don't want to question that. We want to say, yes, there is a constraint that we accept.
Let me now turn to a question that's been asked by Kalkesh Kikani from India private equity sector. As we are getting into some of the governance details, the question is, how speedy can such an intervention be? As we know, the troubles and the losses, both in terms of job losses as well as revenue losses at the SMEs are happening as we speak. They've been quite steep. So do you think that the fund, the governance, etc., that need to be set up would be able to manage the intervention in such a way that it reaches those who need it the most in good time? Let me throw in a related question, is that in that sense, is the proposal much easier to take off, say, in an individual country like Singapore, where you at least don't have to first figure out the national allocation. You still have to address the sectoral allocation point, but at least you have to not deal with the supranational political issue.
Right. Good question. Good question. Actually, we are trying to keep this very much in the picture. Clearly, as you mentioned rightly, implementing such a scheme in a place like Singapore is much easier. It's a much smaller country with very good tax compliance and very good data. So they can do it much better and faster. There is no doubt about it. But I'm encouraged with the success, for instance, in Switzerland and Germany in the last few weeks, where their debt-based programs, I stress those are debt-based programs, have been remarkably efficient. I mean, Switzerland and Germany, and my colleagues tell me, the loans are processed within 24 hours, which is quite in contrast with the horror stories we are hearing here in the United States, where the SBA is totally clogged and the community banks through which they lend are totally overwhelmed by the huge demand in the system. So I'm hopeful, especially in countries with a solid banking system. I think the big strength of Europe is that most of the small SMEs deal with the banks, and the bank-firm relationships are by and large pretty strong. They have been working with each other for many, many years, And the banks have a good understanding of the firms, their managers and owners. So I'm hopeful. For example, in Switzerland, I was surprised. There's a debt program. You just fill in a one-page form, and there are clear criteria. So the banker has to ensure that those criteria are satisfied. Otherwise, he will not be reimbursed by the central fund. And once those are satisfied, there is really no judgment involved. He just has to check off those 6 boxes. If they are satisfied, you get X% of your previous year's revenues or something like that. So I want to make it as objective and essentially automatic as possible, because there is no time for detailed credit appraisal and so on and so forth. I mean, many of these companies go bust if it takes more than 3 months to process the infusion. So I want to keep it simple. I want to keep it with a constraint on who will qualify. And the simple notion is anybody whose business was viable in December of 2019 will qualify. If your business was not viable at that time, you should not qualify. That's basically the simple criteria.
One last question on the fund, Marti, which is that you raised 2 possibilities in your various responses so far. One possibility is that the fund could actually borrow in the market against its stream of cash flows.
Yes.
At the outset, you also mentioned that this could potentially even have equity investments from, private equity and other high seekers.
Yes.
It would seem that given the nature of the underlying cash flow itself is more of an equity style because it's a tax claim on the SME.
That's right.
The debt capacity of this kind of a fund may be rather limited. So the question then is, if you rope in more the private equity investors, do you see them coming in without necessarily having control rights on the underlying SME? So the typical private equity model would be, so in a way, you are sort of designing a structure in which what looks like a limited partner investing in a private equity fund and then investing in the SME, you are turning it around a little bit where the private equity funds now are going to put into more of a passive structure. And it's the passive structure that is now actually extending money. So it seems that this equity structure is a little bit of a reverse of the typical private equity design, where the passive party is the ultimate investor and the active party is the asset manager. Right. We are reversing the order. And so can you elaborate on what would make this click?
That's a good question. See, one of the things that is different about Europe, and here I focus on Europe, is the strength of, for instance, in Germany, the Mittelstand, the middle SME sector in Germany, is its real core strength. If you look at, the big German companies, they are not what makes Germany strong. It's their Mittelstand. And the Mittelstand has been an attractive investment for many PE players, and the similar argument you could make about Spain or Italy with slight differences. But they have been very, very averse to taking any outside capital, certainly not PE capital. So in very exceptional cases, for instance, in Italy, one of the funds tried to do it to basically take care of a sale of stakes between family members and so on. That's how PE players entered into profitable businesses. So I would say that if you offered me a fund that really gives me a play on the German Mittelstand, okay, of course, there'll be some huge successes and some not so good ones. I think that's a pretty good fund. And frankly, that more mirrors the success of the German economy than really the DAX or some other index. I would say the DAX is not the real performer. I mean, there's a discrepancy, and I think it's true to a lesser extent to the other countries. So I think the strength of this fund and the attractiveness for PE players is the fact that you are getting a play on a set of cash flows that is right now not available to people in the market. So that is really, under normal circumstances, they would never have done this. They would never have allowed their somebody outsiders to share in their profits. They say, you know what, we take the risk, we run the business, we know how to run the business, we pay the bank the interest, they're nice enough to give us credit because our business is strong. We don't want anyone to share in our upside. That would be the normal approach of the Mittelstand. But now, because of the circumstances. And via this I would say, idea of working through the tax system, they are also sharing a little bit of the upside and, of course, downside with outside investors. Frankly, I should emphasize, we are not envisaging outside investors coming in at the inception, because nobody knows how all this is going to work out. We see them coming in a little bit later when things stabilize, the global economy is back on its feet, and then I think we can talk about such things. And I do not rule out the possibility of constructing different sub-portfolios within this large fund. Someone takes a play on the airline sector, which is now completely demolished. Somebody else says, I'm willing to take a crack at the automobile ancillaries, and so on and so forth. So that's the sort of broad design we have in mind.
Marti, let me turn now to a question by our colleague Ingo Walter. He throws in a healthy dose of skepticism into the question.
Yes,
I think Ingo is always playing the devil's advocate.
Yes.
But his question is, most European SMEs are paranoid about control rights, which may not be a problem in phase one of your plan.
Yes.
But this could become problematic in your follow-on equity schemes down the line. And therefore, he thinks that the SMEs may try to avoid the scheme if at all they can.
Yes, I think some SMEs will be wary of getting anyone to poke their noses into this in their businesses. But I think that's why this fund is a time-bound fund. It's not going to last forever. Okay, there will be an exit date, 7 years or whatever it may be. But if then after the tax rate goes back to the old levels or whatever the levels are at that point in time, and that's it. The fund is closed, and they give the money back to the investors, whatever is left. So there is no question of poking your nose into the SME's affairs. Even during this period, it's only the tax inspectors who will come and make sure you pay your taxes. It's not that the fund is going to go and send an army of people to check whether you're running a business properly. So, Ingo, I don't think there's any question of anyone poking their noses into a Mittelstand company and asking them questions that they don't want to bother to answer.
Thank you, Marti. Let me ask a couple of questions that relate to national differences.
Yes.
That could become relevant in getting the scheme at least sort of in place with sort of right safeguards and governance mechanisms. So as we know well, the tax evasion capacity, or I should say the tax enforcement capacity is sort of very different across different member countries in the Eurozone. Some countries, debt to GDP ratios would look very different if you took into account the taxable proportion of the GDP, whereas for some member countries, such as maybe Germany or Switzerland, maybe the tax collection authorities actually are able to get at most of what they need. Do you think some of these differences are germane to how the fund might have to be designed? And whether you would then have to factor in a slightly different, in what I'm trying to say is a slightly differential tax rate for different SMEs, or you really have in mind that regardless of these differences, there would be some cross-subsidization and you keep it simple, you simply charge sort of one tax collection rate over the period of this equity?
That's a very good question. Actually, because of my recent conversations with people in Singapore and in India, I've been forced to think about this much more. And of course, you're right. Even across the Eurozone, there are huge variations in terms of tax compliance and the efficacy of the tax systems. So that's why we have a simple rule. If you've been in a tax-paying situation for the average of the last 3 years, or something like that. So that's a minimal criteria. If you did not pay taxes because you didn't make money or you were not bothering to pay taxes, that's it. You're not in the system. Okay, we have that. I know we may be losing some good people in that because of that rule, but I would rather err on the side of saying there's one rule. Of course, it doesn't fit everybody equally well, but because I also have to keep in mind the jockeying for position among the different European countries. If I say there's a different rule in this sector, which is more common, let's say I say tourism sector, which is actually in places like Portugal, Spain, Greece, and Italy. They say, northern countries, also, wait a minute, what is special about tourism? Why don't you do it for something else? So this kind of thing is going to become then a whole political mess. So I'd rather not get into that at the initial stages, have a set of rules that are going to be applicable across the board with all the problems when you try to have a one-size-fits-all policy, and then try to work it out. Of course, some of these have to be fine-tuned in light of experience. I don't doubt that there will be some fine-tuning required. But I don't want to begin by saying there are like 5 different industries and 4 types of firms and size and so on. That will become a complete mess. So that's my fear.
Thank you, Marty. So just pushing on that thread of reasoning a little bit. So in context of India, you would recommend that the scheme be applicable only to those SMEs which are in the net for the goods and services tax in particular, because there's a large number of SMEs in India that have been given exemption from the payment of the GST.
Right.
Now, some of them might be paying the general tax, but at least they are out of the goods and services tax. Is that what you would recommend to start with?
Yes. Of course, Viral, you know this better than I think most people, including me. I mean, the fact of the matter is in India, most SMEs pay little or no taxes for a variety of reasons. And actually, the big thing in India is the value-added tax, the so-called goods and service tax, GST, as it's called in India. That is the primary vehicle for collecting taxes on the SMEs. So we are, of course, GST becomes a much more tricky way of collecting because it's really a value-added tax. So it's very hard to do this. Actually, as we speak, I'm working with the Indian Ministry of Finance to do exactly this calibration. So we're getting data from the income tax people and the Goods and Service Tax Administration, and we're trying to see if a slightly different design is feasible in India, because income tax may not be the right approach in India. So this is something that I'm trying to figure out myself because I don't have a clear understanding of really the GST versus income tax. So the Ministry of Finance people are actually helping me to understand this better. In fact, I have a phone call first thing in the morning tomorrow to actually work on this. They have sent some data and I'm plowing through this afternoon to have a reasonable discussion with them in the morning. My colleague in Singapore is having the same discussion with some of the leading players in Singapore. I think yes, you're right. As you alluded to earlier, in Singapore, I think this implementation may be easier, but you'd be surprised. We already got a lot of pushback from a political perspective in Singapore. And Singapore is going to have an election in a year's time, and they don't want anything that is perceived as really trying to, help one group of voters versus others. So there are these political constraints everywhere. There's no doubt about it. This has to be taken into account. And I'm not an expert on the political part of it. But I do know that one has to have a solution that sits well with the political class. Otherwise, it will not fly. So that I'm aware of, but I am not competent to judge what makes sense. What I will take into account whatever they say and try to work around with those constraints.
A related question on that, Marty, is from Robert Porter, which is that given this difficulty, perhaps in taxing profit necessarily, would you then simply cast the program in terms of a tax on sales? Easier, simpler to implement. Of course, it goes in the spirit of a value-added tax, which is sort of a tax on activity rather than a tax on your calculated profits.
That's a good question. The only concern I have is if I'm actually able to get back on my feet in the next year or year and a half, and my revenues are ramping up, but because of a lot of other reasons, my costs are very high because of re-establishing the supply chains and all the rest of it. I may be improving my revenues, but I still am not making money. And if you start telling me I have to pay a tax, then it becomes more like a debt kind of prepayment problem. So I don't want to fall into the trap of saying, look, this poor fellow is now just getting on his feet. And then suddenly you ask him to pay a tax. And he's not making money right now. And you ask him to pay a tax. I'm a little bit concerned with that. But having said that, however, I don't want to dismiss the concept of linking it to some type of value-added tax in countries where the VAT system, or GST as we call it in India, is well established. And the data, I'm actually surprised and very impressed with the data. And you know this, Viral, from your experience. The GST data are, with all the weaknesses of the GST system, they are actually surprisingly good. And they're able to collect this data very quickly and present it. I was surprised how much detail they provided. And they're able to slice and dice the data in a manner I think is not easy to do even in large, rich countries like the United States. Yeah.
Marty, we have time for maybe 2 or 3 more questions. So let's try and get through them as quickly as possible. Here's a very interesting question from our colleague, Ed Altman.
Yes.
So Marty, you said that this fund and the equity investment will end at some point. So in that sense, it's not a pure equity. It's sort of still something that has a debt-like feature in that there's sort of like an expiration date at which the claim is settled. So his question is, doesn't that really make this look just like long-term debt? And if so, will there be actually enough taxes collected along the way to repay it rather than it just being a balloon payment at the end of the fund's maturity?
Yeah, but I think there's a very big difference. I think it's the risk-sharing aspect. That distinguishes this from debt. I think it's not the maturity or so or any other aspect of it. Frankly, what we have in mind, and again, we are working out the details, we have in mind that the EIB or similar institution in Europe will be like an asset management company. It floats fund 1, and it works out, who knows, there may be a fund 2 or a fund 3 that follows. So this concept, which has been sort of conceived in the context of this crisis, may well be a vehicle for future SME financing. Who knows? So those are all in the distant future. So I think the claim is more the risk-sharing aspect. And the fact is also the pooling of risks across countries and across firms at a level never before seen. We have never seen someone getting a stake, in a Finnish, supplier to Nokia, and a person making, pasta in Calabria, and to have a claim on that kind of portfolio seems to really carry with it a lot of diversification, and of course, not to speak of sharing of risks.
A related question to that, Marty, once again from Harsha Marty, is that down the optimistic branch of the decision tree where the businesses revive and, several of them who have survived want to grow, they will want to raise external capital. Now, at that point, do you think that these outstanding claims, the higher tax claims than usual on this equity, would essentially act like an overhang on the firm, preventing them from raising sort of new growth capital down the line?
That's a good question. So we have an opt-out clause. So in other words, if you want to buy out of the scheme, let's say after year 3 or year 4, you feel you're very comfortable, you can make a prepayment sort of, let's say, amount and say, okay, we are no longer in the scheme. We get out of the scheme because we paid this amount. Okay, so there'll always, this is like a non sort of early repayment mortgage where you want to pay it off. You can pay it off, but you have to pay the present value of that future stream in some way on a risk adjusted basis. So that would be the concept. So you can't just suddenly stop. And once you do, if you have such an attractive future growth opportunity, well, you may be well advised to say, okay, I'll pay off this extra tax burden and I will take the other financing, or use the other extra financing to pay off this tax burden. So those kind of possibilities are there. So you're not sort of stuck with the scheme forever.
Thank you, Marty. So let me pose the last question and then we'll wrap up. My last question is, let's take the three countries you have mentioned, 3 regions and countries. So Europe, Singapore, and India.
Right.
Do you have a rough ballpark for the kind of fund that would the size of the fund that would make a meaningful difference? What numbers would you attach if you want to hazard a guess? One or all 3?
Yeah, to be honest with you, about India, I have no idea. In fact, I would be able to answer your question maybe with a little bit of confidence in a week or so. But right now, I have no idea. In Europe, we have been sort of batting across these numbers. And I think, we have been discussing amongst ourselves. See, the capital of the European Investment Fund right now, the equity capital, is the order of 290 or so billion euro. And they have been raising debt, but they don't raise a lot of debt. I think the debt equity ratio is roughly 1:1, because they have this mandate that they have to preserve the AAA kind of rating. So that straight away puts a damper on how much of money they have at their command. So my colleagues are saying, and this may make sense, don't put a huge number, then everyone will say, no, this is not workable. So we are going to start much more modestly. Perhaps initially the criteria will be somewhat more stringent, so that we have no idea. I think, frankly, Viral, I think this question is relevant, whether you ask about the size of the intervention with the ECB or the Fed, or you talk about the various fiscal schemes in the United States. Nobody knows. Yes. People are saying, let's try this number. And they say, oh my God, this is not enough. Let's put a little bit more. That seems to be the approach, whether it's the Fed or the ECB or the US fiscal authorities or whoever you talk about. Everyone is throwing numbers and hoping something sticks, right? I think we are at that stage. Only when we get more data on the potential repurposed drug, which may work, and or the vaccine prospects that we see a little more clearly, that the vaccine will be available in April of 2021 or something like that, with a high degree of certainty. We know that the vaccine will be available. I think then and only then can we say something more concrete, frankly. And I think, frankly, I'm not a market analyst, but I'm quite surprised by the run-up in the markets. I mean, there is no information, as far as I can tell, positive or negative, that suggests that this is justifiable. But I think, we are doing those calibrations as we speak. In fact, we just to make sure we don't try to do it on a large scale, they are attempting that very calibration with Italian data. So that because we are trying to because Italy is the one where it's our test case. If it works in Italy, it will work everywhere, is our assumption. So we are right now collecting SME data for Italy from various sources. And we are hopeful that we'll have a little more of a handle on that number you're speaking about.
Thank you, Marti. It's really been a terrific conversation, getting into a lot of implementation details of, I think, what's a very innovative and potentially impactful proposal for Eurozone and possibly also for other countries. I also want to thank all the participants for their time and excellent questions. As Marti said, on behalf of everyone at Stern, we wish you and your families the very best in these trying circumstances. And lastly, as always, I want to thank the admin team, the tech team, for all their support and making these Zoom sessions of the Faculty Insight series work seamlessly. Thank you, everyone.
Thank you, Viral. Thank you to the participants. Stay safe and healthy.